If I handed you a balance sheet right now and asked, is your construction company actually healthy? Would you confidently answer, or would you keep scrolling and hope that I move on? Most contractors obsess over revenue and job profit, but the balance sheet, that's the report that tells you if you're building a real company or just running expensive chaos. Today, I'm breaking down balance sheet basics specifically for construction contractors and in plain English. So let's get into it. If you run a construction company, your financial world is different. You have equipment, work in progress, retainage, progress billings, large receivables, payables, debt on trucks and machines, which means your balance sheet is not optional. It's your company's financial x-ray. So at its core, a balance sheet answers two questions. What do you own and what do you owe? That's it. It has three sections: assets, liabilities, and equity. And the formula is simple: assets equals liabilities plus equity. If that equation doesn't balance, something is wrong. But here's what contractors need to understand. Your income statement tells you if you made money this month. Your balance sheet tells you if you're building wealth or digging a hole. So let's talk about assets, what you own. Assets are everything your company owns or is owed. So in construction, common assets include cash. So this is money in your bank accounts, and this is king. But it's not the whole story. You can have low cash and still be healthy, or high cash and still be in trouble. Number two, accounts receivable. This is money customers owe you. In construction, this can be massive. So if your accounts receivable is really high, you need to ask, how old is it? Is it collectible? Is retainage sitting in there? If your receivables are 90 plus days old consistently, you don't have a profit problem, you have a collections problem. Number three on your balance sheet, work in progress. So this is usually for larger, more advanced construction companies, and this is where a lot of owners can get tripped up. WIP represents costs incurred but not yet billed, or billings that exceed costs. If you don't understand your WIP, you might have trouble understanding your real financial position. Overbilled jobs can create temporary cash, and underbilled jobs create hidden risk. Number four on your balance sheet, equipment and vehicles. Trucks, excavators, trailers, tools. Important note on this: the value on your balance sheet is not what you could sell for today. It's original cost minus depreciation. Don't assume the big equipment number equals liquid cash. So now let's get into the liabilities of your balance sheet. And this is what you owe. Liabilities are your debts and obligations. Construction companies can often carry significant liabilities. Number one, accounts payable, money you owe suppliers or subs. If AP keeps growing faster than revenue, you're using vendors to finance your business, and that's dangerous. Number two in the liabilities are credit cards, and high interest debt is a silent killer. If you're carrying high balances month over month, your margins are not as strong as you think. Number three, equipment loans. This is very common in construction, and debt itself isn't necessarily bad. But here's the key question. Is the equipment generating enough profit to justify the payment? If not, it's a liability dragging your company down. And number four in liabilities, payroll taxes payable. If this number is high and unpaid, this is a red alert. The IRS does not play games. So let's get into the equity section of your balance sheet. The equity is what's left after liabilities. It represents your ownership value in the business. If you sold all assets and paid off all debts, equity is what you'd walk away with. Growing companies increase equity over time. If you've been in business for 10 years and equity is flat or negative, you've been working hard but not building wealth. That's a tough reality, but an important one. What are red flags that contractors need to look out for on their balance sheet? Number one, large receivables over 90 days. Number two, growing payables but flat cash. Number three, negative equity. Number four, heavy equipment debt but weak profits. And number five, no earnings growth. And I feel like I could create a segment on each one of these. There's just so much, each one is its own can of worms. But these are the big red flags to look out for. So another big one, if you show profit on your income statement but cash is consistently tight, that usually means either WIP issues, slow collections, overexpansion, poor cost controls, or high debt. And the balance sheet can reveal all that. Here's a quick health check you could use as a checklist. Number one, do you have positive equity? Number two, is your cash growing year over year? Number three, are receivables under control? Number four, is debt tied to productive assets? And number five, is retained earnings increasing? If yes, then you're building something real. If no, then we need to fix some structure before chasing more growth. Because growth without balance sheet strength just makes problems even bigger. I know revenue is exciting, big jobs are exciting, new equipment is exciting, but the balance sheet, that's the quiet truth. It tells you whether your construction company is stable or fragile, funded or leveraged, or growing or surviving. So start reviewing it monthly, not just once a year when your CPA sends it, and you need to get your taxes done. Understand what you own, understand what you owe, and track whether your equity is growing. Because at the end of the day, you didn't start this business just to stay busy. You started it to build wealth. So if you need help with any of this, reading your balance sheet, structuring things correctly for future, making sure you're growing the right direction, please feel free to book a time. Our calendar link is down in the show notes. Hope you found this helpful and see you in the next one.